Wouldn't surprise me to see triple-digit numbers in silver prices as we see this cup and handle unfolding here. It's going to be very volatile, and as we see that volatility play out, I think investors are going to have to take advantage of those big movements. But you want to be buying these things before the big move, not after. When all the confirmations become very clear that we are in an upward trend, by that time, you're not going to find any distressed assets anymore. So distressed opportunities are distressed for a reason. And so I think that's to me, it's more of a setup to take advantage of rather than run away from it.
In a recent interview with Liberty and Finance, Tavi Costa, a partner at Crescat Capital, expressed a belief that silver could reach triple-digit prices in the future. However, they cautioned that this potential increase would likely come with high volatility. Costa emphasized the importance of investors aiming to purchase assets before significant price surges, as once a strong trend is established, distressed opportunities may become scarce. Joni Teves, a precious metals strategist at UBS, echoed a similar sentiment in a statement to CNBC. Teves highlighted that during periods of Federal Reserve easing, silver often outperforms gold. They noted that silver has notably lagged behind gold recently, suggesting considerable room for a dramatic catch-up in the silver market. Silver's value is closely tied to its industrial uses, as highlighted by the Nasdaq. Due to its industrial applications, the overall economy's health can significantly impact silver prices. Despite the lack of a clear breakout in silver prices, Tavi emphasized that this is not the time to be discouraged. He believes this presents an opportunity to stay laser-focused on silver investments. The silver market has remained range-bound, with fluctuating prices between $22 and $23.50 levels. The 52-week high reached $26.13 on May 4, 2023, while the 52-week low was recorded at $19.90 on February 23, 2024. Tavi anticipates that as gold breaks out decisively, it will attract capital to the industry, with silver leading the way in terms of potential gains. For some investors, silver could even outperform gold in 2024 after lagging for several years. Why might silver outperform gold in 2024? And how could you best take advantage of this situation? Join us as we explore the insights shared by Tavi Costa. Stay updated by subscribing to our channel and activating notifications. Thank you.
A macro investor, I think you want to be early in those trends and accumulate assets before those breakouts. So those assets that are distressed become incredible opportunities as you see prices of the metals increase and change the economics of every project in the world. And so I think that's really one of the things that really makes me so excited about silver. I mean, gold to silver ratio today, it's over 85, which historically, every time we've seen that, it actually coincided with periods when you want to be buying silver, not selling. There are some really outstanding opportunities out there with important projects that have been already operating mines with great silver production profiles that will offer even better economics as we see silver prices breaking out. So my focus right now has been solely in that front. And, I don't think this is the time. The fact that it hasn't happened yet, that breakout from that cup and handle, doesn't mean you should be discouraged and changing your focus. I think this is the time when you want to be extremely laser focused on this opportunity. And given the fact that we're all waiting for a moment where gold really breaks out more decisively, and as we see that happening, I think that's going to drive, not only attract capital into this industry, but really I believe silver is going to lead to the upside in a big way. And so, precious metals to me is the main focus. And so I really want to make sure we have a large exposure there.
Now, that formation, the cup and handle formation, what type of price does it really forecast or predict for silver?
Well, cup and handle formations, usually you have a breakout from those prior highs. And so you would expect that, a triple digit number in silver prices. And so at the end of all this, but it's going to be very volatile. And as we see that volatility play out, I think investors are going to have to take advantage of those big movements. But you want to be buying these things before the big move, not after, when all the confirmations become very clear that we are in an upward trend. by that time, you're not going to find any distressed assets anymore. So distressed opportunities are distressed for a reason. And so that's really why you can find mines today trading at 2-3 times free cash flow at current metal prices, which is crazy. It's more of a setup to take advantage of rather than run away from it. And wouldn't surprise me to see triple-digit numbers in silver prices as we see this cup and handle unfolding here.
On Friday, the gold price resumed its weekly uptrend and is poised to close the week in positive territory. This rise was propelled by the decrease in U.S. Treasury bond yields amidst subdued news flows. Federal Reserve officials continued to issue statements, with New York Fed President John Williams aligning with his peers' recent commentary. The gold-dollar pair is trading at $2,038, reflecting a 0.70% increase. Tavi suggests that gold could emerge as a more appealing and effective defensive asset within portfolios. He also discussed the central bank's gold holdings, which have dwindled from 70% to below 20% of their balance sheets. This could pave the way for an upsurge in gold's value in the future. Despite the financial markets showing a preference for riskier assets, today's market sentiment is not weakening gold. Its stability is attributed to the drop in U.S. Treasury yields. Tavi believes that gold and other precious metals offer an intriguing investment prospect, especially due to their potential to augment returns and serve as a buffer against market volatility. Let's get back to the interview.
An appreciation of the treasury market certainly brought a lot of attention, and it's been sort of covered, those issues, by the fact that the equity markets have done so well. So if you own a 60-40, 60% of your portfolio actually did really well the last year or so, but that's probably going to change. And as we see treasuries becoming less and less of a good diversifier for those portfolios, I believe that gold is going to be entering the arena and starting to become a larger and larger percentage of those defensive allocations in portfolio construction. And so that's one side of it. And the other side of it would be central banks, because if we do the same calculation on central banks, they also own, before, in the past, used to be 70%, over 70% of their balance sheets used to be gold. And now it's less than 20%. So that has a lot of room for change. We know that central banks have been buying record amounts of the metal. But when you put it into a historical perspective, there's a lot of room for that to grow. And so, I like stories, or I like investment ideas that have that alternative and large percentage of ways to for your thesis to play out. And I can't think of a better one than precious metals, because you have the 60-40 portfolios being pressured to change their allocation. You have the central banks doing the same. You have the skepticism across, the globe, really, towards the metal. You have most people focus on crypto now, and crypto basically is NASDAQ, right? It's the same trade. I mean, if you look at Bitcoin and NASDAQ, it's no difference, especially in the last 3 years. And so I think that that's all linked. And to me, it's a much better opportunity to be a buyer of metals here, because I think that price change will be very meaningful in terms of changing the multiples of businesses that have that leverage towards the gold and precious metals overall. And as we see that occurring, I think it's going to create a lot of a great generational wealth opportunities. If you look at the fundamentals, they haven't drastically changed in the last 2 years or so. Well, the big changes, if you see, is companies are still doing more and more shareholder-friendly policies, such as especially dividends. Some of the miners are now paying more dividends than the utility companies. Utilities, for those who don't know, is a proxy for treasuries. People buy those companies in order to receive yield. And knowing that a lot of those yielding instruments are actually lower than miners, which carry a lot of capital-intensive properties and other things, it is very telling of how conservative those companies have been in the mining space in order to attract investors to invest in their companies. But from a usual, argument regarding the miners is the fact that we're seeing production costs rising substantially. The problem with that analysis is that people immediately then link that to energy prices, and then link that back to oil. And if you looked at, now I saw somebody else commenting on one of my tweets regarding how, you want to be buying the miners when the gold to oil ratio is declining. And that sounds plausible, right? Unless you really understand the mining industry. And if you do understand it, you will see that energy costs, despite the fact that it's something significant, it's not all the main factor you should be focused on. In fact, the prior bull market we had in the mining space, which was the early 2000s, a sustainable bull market that we had, the gold to oil ratio was actually falling, not rising. And so, that to me is very telling.
Lower interest rates usually make holding gold more attractive as it is a non-yielding asset. However, with the expectation of higher rates, investors are less likely to favor gold. Giovanni Stanovo, an analyst at UBS, also believes that Fed officials' more hawkish stance has had a small but noticeable negative effect on gold. This hawkish stance implies that the Fed is more concerned about inflation than economic growth, which usually leads to tightening monetary policy, including raising interest rates. Higher interest rates generally weigh on gold prices as they increase the opportunity cost of holding the metal. That's all from us. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.